They also have 100 billion in long-term assets to 50 billion in liabilities. Very stable company here. These guys aren't going bankrupt anytime soon. Hey everyone, welcome back to my channel. So today I'm looking at Intel. It's a very highly requested stock that I give my opinion on. So I haven't done it for a while, so I thought I'd jump into it today. Now, I'm going to do my quick valuation of it, just like a high level valuation. I'm not going to dive deep into the competitive analysis or anything like that. I'm just going to go through my 9-point checklist and then give you my opinion at the end. So let's jump in. So a little background on Intel is that it's the largest chip manufacturer in the world by revenue. It's got a $200 billion market cap, so it's already very big. It has been losing ground to AMD. It's a strong competitor that they have. They've been losing ground to them for many years now. So that's an issue with when I'm projecting out growth rates going forward. And look, this is a totally old and boring company now. It's been kind of forgotten. Just have a look at the price chart here. So back in 2000, in the old dot-com bubble that was happening, well, look, the price shot up to well above $70 a share. And then because that was complete hype, and it's obviously reminiscent of things that are happening a little bit today, that the hype just got so crazy that the valuation of the company didn't make sense to that stock price. And over the subsequent years, from 2000 to 2003, it went from 70 down to about $20, let's say. So it took all the way up. It's only $50 odd now, so it still hasn't recovered from those super highs of back in 2000, even though it is about 5 or 6 times better company now because of how much money it makes. That's how the stock price can lose touch with the valuation of the company. And look, this stuff happens, and this stuff has happened here. It happened with Amazon. It happened with lots of different companies as well. Cisco's another one that I can think of, where in 2000 to 2002, the hype just got crazy and stocks like got crushed because the prices just got silly. And I think that like Tesla, and there's lots of companies out there that the hype around these companies is not matching the stock price. The stock price is not matching the actual underlying valuation. So look, it's really important. Price is super important, and it makes or breaks an investment. So let's go see how the quality of the company first, and then we'll look at the price at the end of the video. So to do that, I'm going to look at revenue growth. So I just want to see the business getting better, and revenue is a good way to see that. So if I look back at 2011 and I look at today, it's gone from 50 billion to 78 billion. So revenue has been growing over that 10-year period. So we have to see, we can give that a tick. Then I'm looking at gross margins. Now, the reason I look at gross margins is because if gross margins, anything above 40% is good, but if gross margins have been declining, it means that maybe their competitive advantage is getting weaker because they're having to compete maybe on price. It's not exactly why, but it's a good indicator to see that something is probably off from a competitive point of view in the company if gross margins are declining. And it has been declining ever so slightly from sort of the low 60s to now about 56%. So I will give it a cross here. It's really not bad. Normally I'd be giving it a cross if it was going from say 60 or 70% down to 40 or 50%. This is a slight decline. Maybe it picks up in the next few years. Something to watch out for. It's probably not a big deal, but something I do want to pay attention to. Return on invested capital is next. So essentially how good the management team are investing back into the business to grow it. And we've got here return on invested capital. Now it's all been double digits for the last decade, which is really good to see. At the moment, it's around that 17-18% number. They're doing a fantastic job here of growing the business with their by investing in the capital that they're investing in. They've been getting returns from that. So that's great to see. So that's a good sign of good management. Debt is next. So I want to see that their short-term assets are bigger than their short-term liabilities. And we got 61 billion compared to about 30 billion. So it's about twice as much, which is fantastic. They also have 100 billion in long-term assets to 50 billion in liabilities. Very stable company here. These guys aren't going bankrupt anytime soon. And this is how we check that. So if the liabilities, the short-term liabilities were more than the assets, it means they'd have to raise some money somehow. Maybe they have to sell off some of their assets or issue some more shares or something like that. But in this case, they don't do any of those things, so we're good to move on here. Next up is free cash flow. Essentially what we get as an owner of the business is the free cash flow. So I look here and I want to see this growing with the revenue growth, and it's gone from about 10 billion to looks like about 17 billion. Now, it looks like in 2020 it was 20 billion, but it's come back down a little bit in 2021. Maybe that's something to do with the chip shortage in the world. I'm not exactly sure. I'd have to look in to see what the management team are saying about the slight decline in this year, but generally speaking, it's gone from 10 to 20 billion. So yeah, free cash flow is fine. Now, if you're interested in buying, selling, or holding shares, you're going to need a brokerage account. So I use Interactive Brokers and Saxo Bank. Interactive Brokers is my preferred brokerage account because it's got a long history, it's been stable, it's been around for a long time, and it gives you access to international markets, and that's really important. Plus the fees are really low. Now there's a link in the description where you can go and play around with even a demo account. And I've just made a video recently on how to sell put options through that demo account. I'll have more resources coming out in the future about how to use Interactive Brokers, and I have some videos in the past as well. So check all that out. Interactive Brokers are far better than the Robinhoods and the Weebles and those companies of the world because yeah, they give you access to international markets and they've been around for a lot longer. Okay, next up is shares outstanding. We want to see this number hopefully declining, if not stable. So now 2011 we had 5.4 billion. Now it's down to just 4 billion. So every year it has been declining, which is fantastic. It means the value of the shares that if you were holding these shares and you own the company, the value of these shares are being increasing because there's now less shares in the world. That's fantastic. So yeah, we don't see that all the time with tech companies. So that's really good to see. Apple is another company that's been doing it a lot lately. But yeah, good to see Intel doing that too. Now we go check for insider ownership because we want the management team aligned with us as shareholders. So I go and have a look at the leadership team. We've got George Davis, Stephen Rogers, Gregory Bryant. Look, they own about $5 million worth of stock, but their compensation is significantly more than that, which means, well, their salary is more important than the stock price, which is a problem because I only really care about the stock price. I don't care about their salary, of course. So that's a cross for me here. But if I actually scroll down a little bit further here in Simply Wall Street, I can see what has been going on with the insider transactions of late. And in the last year, there has been a lot of buying going on here from the insiders. So they might be trying to build up a bigger position in the company, which is good to see. It means there's only one reason why someone would buy shares in this company is because they think it's a good investment. There's a million reasons why they could sell. Maybe they want to put their kids through private school or get a private jet. I don't know, but there's only one reason they buy, and that's because it's a good investment. They want to make more money. And there's been a lot of buying activity here. So I'm still going to give it a cross because the incentives aren't aligned, but they are improving. So that's another one to look out for. Now I like to go see what the super investors have been doing, whether they're invested in the company. So to do that, I go to Dataroma, and here is the list of the portfolio managers who have invested in Intel. Now we've got Seth Klarman and Daniel Loeb, who I'm very familiar with, and they have quite big stakes. Seth Klarman has about 10% of his portfolio in Intel. Daniel Loeb about 5%, and he's been adding a lot more recently. So look, there's some very smart guys, and they're a lot smarter than me. So for them to be invested heavily into Intel, that's a pretty cool sign. Now we've got to the most important part, which is the price. So we're going to value the company and then compare that to what price we should be paying for it and see whether this is anywhere near what it's a good deal or not at the moment. Now, I like to be very conservative, and you'll see this here in the numbers. Now, I've gone ahead and put in a lot of this information already. So the growth rate I've used is 15% for the next 5 years and 10% after that. Now I'm going to play around with these numbers because analysts think that's not going to happen. They actually think it's going to be in like a negative growth rate or zero. So I'm just took the last 5 years of growth and just extrapolated that out over the next 5 years, just to show you what that would look like. Now I'm using a really big discount rate here of 30%. Because that's what I like to go for because it gives me a really big margin of safety, but I could be a little bit more conservative and call it about 22% would probably be okay. That means I'm probably trying to get 15-20% return on my investment with a small margin of safety. Now, with my numbers here, with this growth rate, it's telling I should be buying this about $35. I don't know when you're watching this, but the stock price is about $50. So it's not too far away, I guess, if I feel like these numbers are right. Now, let's change this down to 22%. And it's telling me I want to buy this at about $56, which is actually higher than the current stock price when I'm making this video. So look, if you think it's going to grow at 15% for the next 5 years, well, this is pretty good buying right now. But like I said, there's competition coming in. The analysts don't think this is not going to happen whatsoever. So let's put it down to, well, let's just make it 0. And then from years 6 to 10, they come back to some sort of growth. Now we're talking with that 22% discount rate. Now we're talking back down to 35%. And if I wanted my 30% discount rate that I like to use, now we're talking like 23%, which is about 50% discount to where the stock price is today. So for me, I would feel more comfortable using these conservative numbers, maybe using 0%. So we're talking $25 maybe. So look, for me, this is probably not quite there, but I can see how other people could justify paying about $50 a share at the moment, because I wanted a big discount rate, and if they believe the growth is still there and disagree with the analysts, well, this is probably a buy. So I'm just unsure of those growth rates, and I think 0% is probably fair. I don't know what the competitive advantage Intel has over AMD at the moment and why they're losing market share. So that's something I really need to understand. There is a lot of insider buying recently, so that's a pretty good sign. The financials are really solid. Like, those gross margins were high, it was just slightly declining. The insiders are buying more stock. So really it could be a tick across the board here. The shares outstanding number declining as well is a really good sign, which means we're getting some growth out of the valuation of the company, even if the business isn't growing. So there's a bit of hidden value there. And I guess I do see why value investors are starting to get interested in this one. For me, I'm not there yet, but it's something that maybe warrants a little bit more research and ticking off some of those things like the competitive advantage. Now, I do hope you've enjoyed this video. I know there's a lot of other YouTube videos out there on Intel, but this is my take on it at the moment. I hope you've enjoyed it, and I'll see you next time.